What if I told you that one single concept could stop most investors from losing everything in a crash? And it's not a secret trading trick. It's a way of thinking, a disciplined approach that separates real investing from gambling. Stick with me for the rest of the video and I'll show you the difference between investing and speculation, and why inflation is the silent thief of returns, plus the practical rules you can use to protect your money. This isn't about making a fortune overnight. It's about a framework for making decisions that protect capital and give you a realistic chance of steady gains. Benjamin Graham, the father of value investing, wrote these principles decades ago, and they still work. He defines an investment as an operation which, after thorough analysis, promises safety of principal and an adequate return. Anything that doesn't meet that test? That's speculation. Today we'll translate Graham's ideas into plain English: how to think like an investor, how to keep speculation in a small, controlled pocket of your portfolio, and how to shield yourself from inflation. At the end, I'll give you 4 practical takeaways you can use right now. Imagine 2 people at a market. One carefully inspects the goods, compares quality and price, and walks away satisfied with a fair purchase. The other bets everything on a rumor that prices will keep rising. Graham says only the first is an investor, the second is a speculator. Graham's definition is simple and strict. An investment operation promises safety of principal and an adequate return after thorough analysis. That's a high bar, and intentionally so. If you can't justify the safety and return under careful review, you're speculating. Today, everyone who buys or sells a stock is called an investor by the press. But that sloppy use of the word hides the real danger. People who think they're investing when they're gambling. Graham warns against confusing the two, because the wrong label leads to the wrong behavior. Graham says speculation is fine in small doses. It lubricates innovation and markets. But it becomes dangerous when you speculate while thinking you're investing. You speculate seriously without the skill. You risk more than you can afford to lose. Graham recommends treating speculation like entertainment. Keep it small and separate. Have a dedicated mad money fund if you must fiddle with hot stocks or short-term bets. Don't mix that money with your core investments. A rule of thumb he gives: keep the speculative portion small. The smaller the better. Graham divides people into 2 types: the defensive investor, who wants safety and freedom from bother, and the enterprising investor, who's willing to spend time and effort for higher returns. Defensive investors should focus on quality, diversification, and low-maintenance strategies. Enterprising investors can pursue undervalued bargains, but only where analysis shows a real edge. Neither should confuse speculation with investment. Don't expect miracles. Graham's point: investing is about minimizing the chance of irreversible loss and maximizing the chances of a reasonable, sustainable gain. If you chase huge returns without analysis, you're rolling the dice. If you follow disciplined rules, you'll probably do fine over the long haul. But fine is different from spectacular. If investing protects principal, inflation eats away at the value of that principal. Chapter 2 asks, how should an investor respond to inflation? Graham's answer is practical, not panic-driven. Inflation reduces purchasing power. You might get a high nominal return on a bank product or bond, but after inflation, your real return can be 0 or negative. Graham calls this the money illusion. We focus on the number printed on the statement, not on what that money actually buys. Some argue stocks are the perfect hedge against inflation. After all, companies can raise prices. But Graham warns, this is not guaranteed. Stocks can be risky, and there are times when bonds actually outperform stocks depending on yields and valuations. You shouldn't replace all bonds with stocks just because you fear inflation. Balance matters. Graham looks at history and shows that inflation swings dramatically over time. The US has had painful inflation episodes, the 1970s being a clear example, and other countries have suffered hyperinflation. What he recommends is insurance, not a full-scale shift. Keep a portion of your portfolio that can help protect against rising prices, but don't abandon balance. Graham's practical tips: hold a mix of stocks and bonds. Don't put everything in one basket. Consider real assets like real estate or precious metal-related investments, but don't overdo it. He suggests small allocations. For retirees or income-dependent investors, preserve liquidity and safety. Inflation protection must be balanced with income needs. Graham notes a political reality. Governments that borrow heavily can benefit from inflation because it erodes the real value of debt. That doesn't mean inflation will always happen, but it makes it unwise to assume we're forever safe from big price rises. Prepare accordingly. Here are 4 actions you can take right now, based on these 2 chapters. Label your activity. Distinguish investment from speculation. If you can't justify safety and an adequate return, treat it as speculation and limit the size. Use 2 buckets. Keep a core conservative portfolio, defensive, and a separate small speculative pocket if you want to take risks. Don't mix the 2. Balance for inflation. Don't rely on one asset to solve inflation. Diversify and include assets that historically help preserve purchasing power, but keep allocations modest and reasoned. Guard against irreversible loss. The big enemy is permanent capital loss. Your rules should minimize that risk first, returns second. I want to hear from you. Which of these rules surprised you most? Do you already keep a mad money fund, or do you blend your trades with your long-term holdings? Drop a comment below. I read them and reply. If you found this helpful, hit like and subscribe. Next video will break down Graham's approach to building a defensive portfolio, how much to hold in bonds versus stocks, and a simple formula you can use today. If you want this script formatted into scene-by-scene shot timings and ready to import SRT-style markers for Runway ML, in Video AI, say make scenes, and I'll output that right away.